Good morning. Good morning, students. Welcome to another class, virtual class on company audit. Before we start with the day and the proceedings, let me apologize profusely for missing one of the ratification, or one of the issues relating to ratification of the appointment of the auditors, which I inadvertently missed. I'm sorry about it. Okay. So let's get along with the day's proceedings. We were discussing about the powers and rights of the auditors. So we had discussed till, I think, just to recapitulate, there are 15 clauses under these section 143, and we discussed several of them. Today we'll discuss a little more about the fraud part of it, fraud reporting. So just to recapitulate, 143.1 talks about the right and powers of the auditors to access to the books of accounts all the time at any place, including the branch offices, including the associates, the subsidiaries, etc., based on the requirement. And 143.2 subsection 3, subsection 4 talks about various things related to reporting that we need to report, and what would be the content of the report, and how do we qualify or emphasize on matters based on our judgment and identification of issues of material importance. And subsection 5 of the section 143 talks about the powers of CAG. 6 also talks about different powers of CAG to order supplementary audit. 7 talks about the test audit that may be ordered by CAG, and 143.8 talks about the branch audit. It can be done by the main auditor, it can be done by separate auditor. Examples I had given you for cases of banks, of course, and of different PSU, large PSUs or large organizations where branch audit is done by other auditor other than the one who's doing the consolidation or the head office audit. Okay. And 143.9 talks about the auditing standards pronounced by ICAI, and 143.10 talks about the auditing standards of government, compliance with that. Because apart from the institute's auditing standards, there could be some standards which are supplemented by government specifically for areas of concerns, and that the auditor need to be complied with such government auditing standards. Okay, and 143.11 talks about the specific report as per the NFRA's requirements. We will discuss about NFRA a little bit in detail in subsequent slides. It's basically regulatory authority which was formed by the central government, and for certain things like audit authority, they have the authority to review our work, the auditors' work, monitor our work, and of course they have say in the auditing accounting standards and financial reporting. They advise matters on the auditing and the accounting standards, and a regulatory body for the auditors also. And 143.12 talks about the fraud reporting. Let's look into a little bit of this. And so what is this that we discussed at several times earlier also, that if an auditor has reason to believe that an offense involving fraud has been committed against the company by an officer or employee of the company. We need to be careful about these particular words so that you remember. So it's by an officer or an employee of the company against the company, then the auditor should immediately report that matter to the central government in a manner as we will discuss. Okay. So what is the threshold, and what is the manner in which it has to be reported by the auditor? So if it's the amount involved is 1 crore and above, it has to be reported to the board or the audit committee, as the case may be, in case there is an audit committee, or to the board. and they are supposed to give a reply within 45 days time. It has to be reported to the audit committee or the board, as the case may be, within 2 days. 2 days of identification of such fraud, and 45 days time will be given, provided to the company to reply against those reported frauds. And on receipt of the reply from the company, the reply should be, along with the issue and the comment, should be forwarded to the MCA, the central government, with the next 50 days. The total time limit is generally given. That's why the total time limit is 60 days. Total time limit is the 60 days. And if the amount is involved is less than 1 crore, the matter should be reported to the audit committee within 2 days. Okay, it's less than 2 crores. It doesn't have to be reported to the central government. So these are and what are the things that needs to be covered? Okay, what are the things that needs to be covered within in that report, fraud report that we are reporting to the government and to the company? Nature of the fraud with the description, approximate amount involved, and the parties involved. So you can understand, my dear students, that we need to do, an auditor has to do a lot of work before such kind of comments in writing can go to the company. That what is the fraud, description of it, the amount involved, and of course who are the parties involved. So this we need to keep in mind. Okay. So this is just I picked it up from the study material only. So just for your recapitulation for the exam purpose, keep this in mind. Section 143, subsection 12, along with the Companies Audit and Auditors Rule 2014, as amended from time to time. So fraud involving amount of less than 1 crore, it has to be reported to the auditor, to the board or the audit committee within 2 days of knowledge of the fraud, and nature of fraud, description, people involved, and the amount involved. And the company bound to disclose certain specified details in the board's report as explained. Okay? And if it is more than 1 crore, if it is more than 1 crore, then the auditor should report it to the central government, but not immediately. It should give 45 days time to the company to reply to the issues that have been identified by the auditor as fraud. So within 2 days of the knowledge of the fraud, the auditor should report it to the board or the audit committee, as the case may be. Wait for 45 days to get a reply. If the reply comes, then along with the reply, observations and the reply and the comments, it should go to the central government within 15 days. But if the reply doesn't come, as I was telling you, last day before yesterday also, that we cannot wait forever. 60 days is the outer limit. So if it doesn't give a reply within 45 days, the auditor will forward it to the government anyway, along with its comments and the details of the fraud which he thinks has been perpetrated. All right. So keep this in mind for your exam purpose in a nutshell, because such kind of a question, situation will be given, and so you need to read properly the amount involved and whether it has been perpetrated by the employee, of the company, and it has been, the fraud is on the company. If the fraud is, on somebody else, we don't have to report on that. But if it has been perpetrated on the company, against the company, by the employee of the company, we need to definitely report it. Now, there are certain more things which we need to, which we will be talking about. So it is related to so it applies for the cost audit as well. Cost audit and secretarial audit also. Okay, so in case anything is identified by such auditors, that also needs to be reported. It is applicable for the branch statutory audit, but doesn't apply for the internal audit. All right, it doesn't apply for the internal audit. Okay, so some more things that I would like to tell you about the fraud reporting. Just a minute. If you have any question, you can start posting it. Please remember, this is really for the statutory audit and the, and the branch statutory audit, and the provisions of section 143 subsection 12, which is fraud reporting. It basically, the provisions do not apply to other professionals who are rendering other services to the company. Okay. For example, it doesn't apply for the tax audit. It doesn't apply for the tax audit or the, the GST and things like that. It doesn't apply. So we need to know about that also, for keep that in mind for your exam purpose. Okay. So internal audit also, it doesn't apply, as I told you. Okay. Branch audit, it is extended to the branch audit. And it, please remember, again, a reiteration that it includes only the fraud by officers or employees of the company and doesn't include fraud by the third parties, such as vendors and customers. Okay. So it is only by the employees of the company, against the company, and not against, not by the vendors or customers who have perpetrated any fraud, if any. Okay. And the threshold I just explained, 1 crore and above, and less than 1 crore. Okay. So that's the bifurcation you should remember. And the threshold of 60 days, including 45 days time for the company to reply in case the fraud is more than 1 crore, and 15 days after receiving it, immediately within 15 days, it has to be reported to the government. And there are certain forms in which it has to be reported. Not, I don't think that would be important for the exam purpose. And nature, and that it contains the nature of the fraud, approximate amount involved, and the parties involved. Okay. So, and how we identify in the course of our performance of the audit, we have identified such, such fraud. And the fraud, definition of the fraud is the same as covered in section 447 of the Act. Many a times it happens that it may not be detected. It is not so simple. People who are perpetrating, employees who are perpetrating fraud against the company, I mean, they would not leave such trace, isn't it? Generally. So it may not be always possible for the auditor to identify such, or detect such fraud, whereby injury has been, intent to injure the company, or to get the wrongful gain or wrongful loss, unless the financial effect of such acts are reflected in the books of accounts. Please remember, for your exam purpose, that the financial auditor is actually reporting on the financial statements. So, if the financial statements are not affected because of such, perpetration of the fraud, it will be very difficult for an auditor to identify it. What do we mean by that? Suppose he doesn't, some payoff by the vendor to the employee in cash or in kind, which doesn't actually affect in the reflected effect. Of course, it doesn't reflect in the books of accounts or the financial statements of the company. It will be very difficult. We wouldn't know. And so we get some, respite from that he is getting a payoff or, a kickback or whatever you call it. And that amount that is not reflected in the books and accounts, an auditor is unable to detect such kind of a fraudulent act. Okay. Because that such kickoff or the payoffs were not recorded in the books of accounts. He has been paid separately, maybe in kind or whatever way. All right. And maybe some other way, the passwords have been stolen. Key managerial persons, they have passwords as compromised. I mean, and it has not affected the financial statements really. So these kind of things are very difficult to, identify. Some more examples as per the guidelines of the institute, like say a particular employee is carrying on parallel business. He is employee of a company, and the company is carrying out such and such business, and the employee is also carrying out parallelly similar business, whereby he is getting the benefit of the customers and the vendors of this company where he is an employee. Okay, so it will be it may not be possible for an auditor to detect the same, since the sales transactions and the purchase transactions are not recorded in the books of the company. Okay, so these are the things we need to keep in mind, and of course we will be guided by the auditing standards 240 while planning and performing the audit process. So that these are the few things you have to keep in mind for the exam purpose, please. Okay. Some more if I need to tell you, I'm just going through it to tell you. Now, there could be, as I said, that it is not mandatory that for other services we need to report. But the question is that if for such other services or non-attestation services, the auditor, identifies that an offense of fraud has been perpetrated by officers or employee, and in the course of providing, and it has been identified by an auditor in the course of the providing such, attest or non-attest services, what will we do? It is good to report. It is good to report that it is matter can be reportable under section 143.12. There is no, bar on that. Okay. Another thing you must keep in mind, that if a fraud has been detected by the management, and or through some by vigilance or through whistleblower mechanism, and has already been dealt with by reporting or whatever, such case is, and the auditor has been informed about it. So in such a case, auditor doesn't have to report again under section 143 subsection 12. So this is an important requirement for the examinees to remember, that the fraud has been identified. The auditor didn't identify the fraud, but management themselves have identified the fraud by some mechanism or other, and it has been dealt with, and the auditor has been informed about it. If the auditor is not informed and he has identified, then naturally straightforward it becomes a fraud identified by the auditor. But if it is identified management and the auditor is also informed, in such a case it is not required to be reported again by the auditor under section 143 subsection 12. Okay. So we have to know a little bit about these different mechanisms that an organization follow through this whistleblower policy, which are mandatory for the listed companies. SEBI, that they must have these kind of policies in place, and vigilance for the, requirements are there for government companies and other places, depending upon the situation and the requirement. So, as I said, reiterate again, that even by the cost auditor, if a fraud has been identified by the cost auditor or the secretariat auditor of the company, it has to be reported under section 143/12, okay, to the audit committee or to the directors, as the case may be. Okay. Whether it is applicable for the consolidated financial statements also. Okay. Now we are talking about the company statutory auditor or a branch auditor. So what happens? And if it is a branch auditor, it gets CFS, the consolidation happens. So if a fraud is identified at a branch level, so during the consolidation, whether that needs to be reported. So what section provides that for the standalone financial statements of the holding company shall also apply to the audit of the CFS. It will apply to the CFS. Since the audit of the consolidated financial statements has also been made one of the duties of the auditor. Okay. So the question is, should the auditor, report such a fraud? Now, if the fraud is suspected to be perpetrated by employees of the company against the company, it has to be reported. So now, report under section 143 arises only if a suspected offence of fraud is being or has been committed in the company by the officer of the employees. Now, at the CFS level, if it is a holding company, if those employees have not perpetrated the fraud against that other company in which actually the fraud has happened, then it doesn't have to be. Please remember, there are two companies, subsidiary and a holding. Okay. Now, the fraud has happened in the subsidiary company, not in the holding company. So now the question is for the CFS whether it will be reported by the holding company. Now, if it has not been perpetrated by an employee of the holding company against the subsidiary company where actually the fraud has happened, then it doesn't have to. Alright. So, auditor of the parent company is not required to report the fraud if they are not being or have been committed in the parent company by the officers and employees of the parent company. Okay, that you remember, but relate to but they are part of their company. Okay, so keep that in mind. That includes, it could be an Indian company or a foreign company, whatever the case may be. But in case the fraud has been committed by the employee or the officers of the holding company, then it will be reported. Okay, by the principal auditor. It has to be reported. I'm sorry. Excuse me. A little bit about just care of caution for the examination purpose. Excuse me for 1 minute. I'm sorry. Now the word said about fraud that we have it is a suspected, the auditor has reason to believe and they are having the knowledge and suspected offense involving fraud. So there are certain things you must understand about, reason to believe, the knowledge and the suspected offense involving fraud. Suspicion. So it is basically a state of mind, you know that, so suspicion is not adequate. Reason to believe is basically comes into existence that we have something in hand to believe. That suspicion is not only a suspicion of our belief, but it is actually has happened and for which you have reason to believe through, some evidences. So you have to have a convincing evidence that yes, there is a possibility that this kind of transaction is actually a fraudulent transaction. It is just not by mere suspicion that it could be but you have reason to believe is through an evidence. Okay. So just keep that in mind for the exam purpose, and that also is defined, objective through the auditing standards. And reason to believe, which has been used in evaluating audit evidence. Audit evidence needs to be evaluated to make such belief strong that yes, there is could be a case, the belief, the suspicion that a fraud has happened. Okay, evaluating the audit evidence and information that's been, you have received during the time for the purpose of the audit, and evaluating such evidences, including deviations and sampling. I mean, one has to probably, if a suspicion is there, one has to may increase the, sample population to have more evidence, because one has to prove, as I said, that if you are reporting, one has to give evidence of such fraud. Otherwise, it will not hold good. Okay, so that we need to keep in mind. And many a times it happens that it is giving a suspicion, but after going through all the evaluation of the evidences and all, it may be, the auditor may decide or, reason to believe that it may not be a fraud case or of a material statement, nature. So materiality is important, that we also have to keep in mind. And, small things may have happened that, we should be doubtful, but we should not be very paranoid about this fraud thing. We have to be vigilant. We need to be, very keep our skepticism on, but we should not be very paranoid about it. And if it is seen that during the time it has been, it has happened, and within the audit period it has been rectified, or, that person or employee has been actioned upon, it is not actually required, okay, to report. Materiality, concept of materiality is fundamental in setting up of an appropriate system of internal control. So we have to keep that in mind for the fraud reporting too. Okay. So because based on that professional judgment, and you see here in this case, it has already been, notified that it has already there that 1 crore and above certain things, and less than 1 crore, below 1 crore, what you're supposed to do. Now, less than 1 crore, one has to decide how you're going to, actually, whether you're going to report it to the management or not. Okay. So these were taken into consideration during, amendments and all. Corruption, bribery, and money laundering and non-compliance of law and regulations, yes, it could give rise to a case of fraud, and hence has to be reported accordingly. Okay, keep that in mind. And if that fraud, if that money laundering, the corruption, or the bribery has happened has been perpetrated by the employee against the company, if he has taken any bribe, which can be substantiated, you have the evidence for that, that can be actually taken into consideration. Okay. So, for example, one example can be given that fraudulent income tax return has been filed, so income tax return has been filed with incorrect information, and it has to be reported. Okay. So, because why we are talking of so much on this, because an auditor is heavily penalized for not, reporting it, and there are even more heavy penalty if he willfully, he himself is a party to it. We'll look into that. Okay. And section 143(12), it gives us some 143(13) gives us some respite from not reporting. Auditor will not be considered as guilty of professional misconduct if he does his duty in good faith, but he could not identify such fraud that may have happened. So one has to prove that in spite of, all the effort, like the payoffs which are not in kind, which we could not detect in spite of, our best effort, and a fraud has happened. later on if it is proven or by identified by a whistleblower through the whistleblower mechanism, and if we can present our case properly, it will not be, it will be considered under section 143 subsection 13. And not to forget about the, the confidentiality, that we are not supposed to disclose information to others unless and until it is required by the law or other, or by the statute. So this is one of such case, that because a fraud has happened, we have to produce a lot of evidences supporting our claim that that our suspicion that a fraud has happened. We need to disclose a whole lot of information, and so that will not be constituted as a duty that we have violated our duty of confidentiality. That will not be affected in case auditor reports such matters to the central government, and as per the code of ethics. Okay, and if fraud is reported by the management, as I said, it doesn't have to be reported separately by the auditor. And keep this in mind. I do not have to go through in further detail of the guidelines on fraud, Institute's guidelines on fraud. You should, a student should go through. I just quickly, took you through some of the instances as per the, guidelines of the Institute's guidelines on reporting of fraud. But before your exam, it would be good if you can go through it. Or if you have any question after you go through it, if you have any question, you can post it. I'll definitely answer, because it's a huge guidelines and we cannot cover the entire thing here. All right. So, but if you have specific questions, do post it. You have any question yet? Let me see. So I logged out. Just a minute. Screen, somebody said screen is not visible. Is that so? I don't know, Samya. Good morning, ma'am. Less than 1 crore, Satrudhan. Am I clear now that if it is less than 1 crore, it is the responsibility of the auditor to report it to the board of directors or the audit committee, as the case may be, within 2 days of identifying such fraud. It doesn't have to be reported to the central government, to the MCA, but we must keep into consideration the materiality. Less than 1 crore is open from rupee 1 to 1, less than 1 crore. So one has to be very, very careful about the materiality, but doesn't mean that even if it is a less amount, but according to the management, who decides, the management says no, it is not material. So it is the independent auditor's judgment. The auditor has all the right to report it. So if he feels that this is the material amount, that's what you want to, you must remember for your exam purpose, that materiality. But yes, the client says no, this is not material, so we do not agree. But if you feel, if you're according to your judgment and justification, very important, we just cannot, because we are independent, we cannot be bulldozing anybody. We have to justify why do we think this figure is actually should be reported, even if it is not material, as per the client's judgment. You have to judge and give the justification for judgment. That's very important. Justification for judgment, because it could be related. It could have cascading effect. It could have cascading effect. I can tell you one example. I can give you one example. Anju, it's 2 days. You can take it as 2 days. Okay. Visible. Thank you, Ranjit. See, I was giving example of the materiality. Now, suppose, for example, the auditor finds out that some vendor has been paid, twice for an invoice, and he has reason to believe, just because I'm saying that an invoice has been paid twice doesn't mean a fraud. and he has a reason to believe with evidence that it has been purposely done by the, an employee or a group of employees, as fraud cannot be done by a single person. It is generally with a collusion, of a group of people. And as we have discussed over the last several days, that it is, a system today is such that one person cannot complete a transaction. Payment of vendor depends on the invoice that is coming from the vendor. So that may not be recorded into the system by the finance guy. It will be recorded in the purchase department, right? So there is so all these we have to see why it could be paid twice. Why do you think it is paid twice? Okay, so if it is a one-off case because of some problem in the system, and if it is identified and immediately rectified, it is not really a fraud. It is a mistake which the client agreed and they rectified it. But on the other hand, if you see, so you increase your sample size, you increase your sample size, that you identify one of such case during the period under audit. Increase your sample size to see any such case, more such cases have happened or not. You come across few more cases, your doubt increases, your doubt goes up. So you start probing into more detail that how this could have happened, and in spite of having so much of internal controls and monitoring in place, these could not be identified by the management. All right. So you start really doubting, and then if you have adequate evidences, and to prove that no, in spite of coming to these things to the notice of the management, they kept quiet, didn't do much. So it is possible that they also colluded that person also colluded with the other persons, and they perpetrated a fraud. If you have such evidence that yes, he was aware of it but didn't take any action, even if those amount is not very substantial as per the management, it needs to be reported, because this will have an effect that if this is kept open like this, today maybe he's perpetrating a fraud of rupees X, which according to the management is not material. Tomorrow it's going to be so high that it's going to be material, and because you didn't, the auditor, even it came to your notice, you didn't inform, it would be, there would be problem for the auditor also, that why you could not identify it, as you have seen in several cases of the fraud, in the bank frauds and all, that audit has happened. Why you didn't see this? So it has not happened overnight or during 1 year. It continued to happen, and then it gave rise to a material amount which becomes a huge fraud. So even during the audit, if something comes to light, which is in your judgment based on the evidence, is not a mistake. It is not a mistake, but is done intentionally. Okay, then even if it is not so material according to the company, but material as per the auditor, there is no hard and fast. I mean, there is no problem if that is less than 1 crore and you report to the audit committee. We can always do that. Okay. I explained this. Auditor is required to report under, a CARO report that under clause 10, whether any fraud has been committed. So we have to be very careful about all this. So the requirement is quite many. Whether any fraud by the company or any fraud on the company by its officers or employee has been noticed or reported during the year. If yes, the nature and amount of the fraud involved is to be indicated. So that's what we should be doing. We don't have to report fraud committed by the company on outsiders, creditors, investors, and this is outside the scope of reporting under section 143 subsection 12. Okay, the company perpetrated some fraud, on outsiders, investors. Under 143.12, it doesn't have to be reported. Under 143.12, be very clear about this section. under this section, it doesn't have to be reported. Okay. And if the auditor report frauds committed by the company, he cannot avail the immunity of section 143(13) and would be liable for professional misconduct or breach of confidentiality under clause 1. Now, what does it mean? If the auditor reports the fraud committed by the company and then you disclose, so there you are, you're not supposed to report it, but you're disclosing, then you are actually violating the confidentiality clause. Okay, so keep that in mind. Breach of confidentiality under the Code of Ethics. So these are, read these together, that if it has been perpetrated by the company on outsiders, you need not, but you forgot this and hence disclose the information to whoever outside, like say to the central government, and you reported that as a fraud committed by company and outsiders, giving all the detailed information about it. And if the company then comes back on you that it is a misconduct under the under the breach of confidentiality, yes, it will be guilty of misconduct. We can't get an immunity under that. Okay, so keep that in mind, please. And cost auditor, so as I said, it is cost audit and secretarial audit is covered under section 100. That is the power, under the power and the duties of the auditor under section 143. So subsection 14 talks about the cost auditor conducting cost audit and company secretary doing the secretarial audit, which is reasonably new. The secretarial audit, a cost audit was there, but there are certain, there are a whole lot of things prescribed who are coming under the cost audit purview, who are supposed to maintain cost audit records and data. So those things are there. One has to keep in mind, is covered by section 148, and the audit conducted under this section shall be in addition to the audit under 143. Okay, so both has to be taken into consideration. 148 specifically talks about cost audit, which takes into consideration the various rules and regulations of the cost audit Institute of Cost Auditors. Also, they have their own rules and regulation standards. So 148 talks about that, who can be the cost auditor, who can be, what are the standards they have to follow, reporting, and this is separately from that also. Secretarial audit has been introduced with the Companies Act 2013, and it's basically a process to check compliances made by the company under corporate law and other laws, rules, regulations, procedures as prevailing on the day, and it is a mechanism to monitor compliance with the requirements of stated law and processes. Okay, so you always, if you see a listed company's financial statements, audited financial statements, a paragraph would be there signed by the company secretary, which is the auditor, not the company secretary of the company. Okay, and lastly, last subclause of 143, section 143 talks about the penalties for non-compliance. So penalties, if a chartered accountant, company secretary or cost auditor do not comply with the provisions of this act, all right, he will be punishable with a fine which will not be less than rupees 1 lakh but can be extended up to 25 lakhs also. Okay, certain more non-compliances, some more non-compliances relating to other sections of the act. Other sections of the act, like other sections of the act, like 139, 143 appointment, 139 appointment powers, 143 we just discussed, and various services. 144 talks about various services which we can do, and the reporting under section 145. Auditor shall be punishable if we are in violation of any such subclauses under these sections. Auditor will be punishable with a fine which is not less than rupees 25,000 but may extend up to rupees 5 lakhs or 4 times the remuneration, whichever is less. And auditor has, so this is in violation, if you are violating. And if you are willfully, the second one is to note that auditor has contravened such provisions knowingly and willfully. The first one is that it was our mistake, but that also will be penalized for. If we made a mistake unknowingly, we will be penalized. But if knowingly and willfully, with an intention to deceive the company, to deceive the company or the shareholders or creditors or the tax authorities, direct, indirect, whatever. So the auditor will be penalized with fine which shall not be less than 50,000 rupees but may extend up to 25 lakhs rupees or 8 times of the remuneration of the auditor, whichever is less. Okay, so keep that in mind for your exam purpose. To keep in mind now the criminal liability. Criminal liability of a firm is basically on the in case of a firm, okay, and if it is criminal offence has been perpetrated, the partners have acted. The firm cannot act really fraudulently, so the partners have acted in fraudulent manner. In such a case, in collusion with others, so they will be, they will be all liable. Okay. So a partner who is basically signing the report and or he was involved in that particular audit. So he will actually be liable for such criminal offence. The firm will actually pay the penalty for it in terms of the money, but for the criminal offence, it will be the partner involved. Okay. And it could be jointly and severally. That depends on the partnership, deed also. So other partners and all the partners or the partner concerned can be jointly and severally be accounted for. Okay. But in case of a criminal offence, it is only the partner who has committed the actually done that fraud. Any question? Any question on this? And some more, if such non-compliance, refund has to be made. The audit fees has to be refunded by to the company. Pay for damages if if they claim. And please remember, for criminal liability of an audit firm, partner or partners who acted in fraudulent manner will be only liable. Okay, the last one, this is what I was talking about. Okay, you have any question? No question? Okay. Okay. If you don't have any question, we can move on with the other parts of this. The NFRA, the National Financial Reporting Authority, was constituted by the government in 2018 under subsection 1 of section 132 of the Companies Act. Now, what are the duties and responsibilities? What are the duties and responsibilities of NFRA? To recommend accounting and auditing policies and standards to be adopted by companies for approval by the central government, pronounced by ICAI, monitor and enforce compliance of auditing and the accounting standards for certain companies. I mean, not for all. There is a threshold. Now, so they would monitor the compliances of the auditing and the accounting standards. So the moment it is about the auditing standards, it's talking about the professional accountants, and when you're talking about the accounting standards, it is actually monitoring the companies. So in principle, they are basically monitoring both the companies as well as the auditors of the companies, and oversee the quality of the service of the professionals associated with the compliance with the such standards, whether it's auditing or accounting, and suggest improvements from time to time, and perform such other services as may be required from time to time. Now, where it is applicable? Where is this applicable? It is applicable, of course, for all the listed companies, whether it is, within India or outside India, all listed companies, and unlisted companies. Even for the unlisted companies having paid up capital of not less than 500 crore rupees, or having annual turnover of not less than 1,000 crores in aggregate, or having in aggregate outstanding loans or debentures and deposits of not less than 500 crores as on 31st March, immediately preceding financial year. And keep that in mind. Insurance companies, banking companies, companies engaged in the generation of electricity companies governed by any other act, and any body or body corporate where government may have interest, government or public has interest, and company incorporated or registered outside India, which is a subsidiary or associate of an Indian company. Okay. If the income or net worth of subsidiary or associate company exceeds 25% of the consolidated income or consolidated net worth of such company. If the parent company and subsidiary company audited by the same auditor in respect of the... No, it is not the question of the auditor, whether it's the same auditor or the different auditor. Here the question is, who has perpetrated the fraud? Okay, who has perpetrated the fraud? If the fraud has been perpetrated by the, by the parent company's employee on the subsidiary company, then it has to be reported. Whether it is audited by the same auditor or not, that's not the only question. The question here is, who has audited? Who has perpetrated the fraud? If the parent company's employees have perpetrated the fraud on the subsidiary company, yes, then what you have written, it has to be, reported. It has to be reported. It imposes, professional misconduct happens, penalties are imposed. So that's the imposition of the penalty, including debarring of a firm from engaging self from practice as a member of the institute for a minimum period of 6 months and not extending for more than 10 years. Last class, I got a question on, this continuation of auditor, or appointment of auditor in case of in case of some criminal offense or something you said, which is for 10 years, whether it should be 10 years and again a cooling of 5 years. As per my interpretation, after reading, what it says, this discontinuance from the audit should be for a continuous period of 5 years. Okay, so that discontinuation for 5 years continuously will be enough for reappointment. Okay, so that way it won't be 15 years. I have not come across such a scenario, but reading in more detail and trying to understand the interpretations of the sentences, that it is a continuous discontinuance for 5 years, consecutive 5 years. One can be, one is eligible for a reappointment. But in this case, he has to wait for 10 years because his criminal offense is going on. So that 10 years would be good enough. That's what I think, that's my interpretation, going through the, inner meaning of the wordings. But still, I will still look for some more such cases. If specific such cases are there somewhere, I will try to identify if it is saying something else. But I think that should be the interpretation. Okay, if you do not have question, Jose, I think that's okay with you, that it is not really about the auditor. It is actually about the, employees, or the employees of the who's committing that fraud. Employees of a subsidiary committing the fraud, or employees of the parent company, perpetrating the fraud on the parent company. Then it will be. Otherwise, the subsidiary company is anyway reporting. Subsidiary company also has to follow the, this act, and there they are reporting. The auditor, whether it is a same auditor or not, he is anyway reporting. So the parent company doesn't have to report again in the CFS if it is not perpetrated by the parent company's employees. I hope that's okay, clear with you. But for the branch and all, if it's related to the branch, it has to be taken into consideration for CFS. Keep that in mind. Because why? I think there we are getting a confusion. In branch, we are not separately sending. Branch auditor is reporting to the central auditor, right? So in such a case, central auditor's responsibility is to report, and where he is actually consolidating the branches. And CFS also includes other subsidiaries, associates, everybody. Okay, CFS doesn't mean the branch consolidation. It also means the consolidations of the subsidiary, associates, etc. Right? So if a fraud is there in the branch, it is the central auditor's responsibility to report. And if it is in a subsidiary or associate and not perpetrated by the parent company's employees, then it is not required to be reported in the CFS, simply because those other companies will be there is a separate report, and reporting to the central government, or as the case may be to the board. They are a separate entity, but they are also subsidiary. Okay, so they have made so one has to go into the details, into the skin of the fact. So a central auditor of the parent company has to actually see whether the subsidiaries or the associates, or financial statements covered those cases. Otherwise, how he would come to know that fraud has been reported, and he has reported it. If it is more than 1 crore, it has been already communicated to the board. Less than 1 crore communicated to the board. If they have waited for 45 days, maximum thing he can say that he has reported, whether it has gone to the central government or not. So it is really depends on the case. Now here, one thing you must keep in mind, it is not mandatory. But if it is seen that it is not done, of course the central auditor would do it. We have to go into little detail from the theory also. Theory is that it doesn't have to be reported. But what happens if the subsidiary company has not reported it? Then will he keep quiet? No, he has to report it too. All right, he has to report it too, because it has not been reported. All right, so one has to go into the details of that. So keep that in mind, please. The thing is that it has to be reported, depending upon the threshold and the judgment and the evidences. Whole lot of things have to be kept in mind. All right, Jose, I think it's give me a positive or negative acknowledgement whether it is understood. Okay. All right. So now we move on to, so we don't have to discuss much about NFRA. Otherwise, let's move into the financial accounts preparation and presentation. Now, Ind AS, which is there, and since you have separate paper financial reporting, so naturally we will not discuss Ind AS at all here. So just remember, Section 133 of the Companies Act, you are already aware, states the central government may prescribe the accounting standards and any addendum thereto recommended by ICAI in consultation with and after examination of the recommendations made by NFRA. That's all. Okay, you have separate paper. So now the financial accounts preparation and presentation. Let's come into this. How the balance sheet profit and loss account, if we can use the crude word, the balance sheet profit and loss account and the notes are going to be prepared. That's the financial accounts preparation and presentation. Not only preparation, but how they should be presented to the stakeholders. How they are going to be presented to the stakeholders. That's covered under Section 129. The subsection 1 talks about financial statements that give a true and fair view of the state of affairs of the company and comply with the accounting standards notified under section 133 in case where it is required. The companies who comes under Ind AS requirement. 129.2 talks about board of directors of the company shall lay before such meeting financial statements for the financial year, right? To the board, to the members, it should be adopted. It should be adopted by the board. It should be adopted by the members in the general meeting. And of course, 129 subsection 3 talks about consolidation of the financial statements and certain, penalties on all the directors and the CFO and the whole-time director, managing director, in case it is not, there is some non-compliance with the requirements of this section. Okay. Exemptions where this is not required, banking companies, insurance companies, power generation companies. Okay. So, we will come to the Schedule 3. Okay, before we go to it, as from the study material, if you have any question on reopening of accounts is not, generally is not permitted unless and until application is made to the central government and or to the income tax and the SEBI and any other, not or. It's all everywhere. I mean, it has to be application to the central government, to the SEBI, to, if it is listed, to the income tax authorities and any other statutory regulatory bodies where this company is actually being governed by, that the relevant accounts were prepared in a fraudulent manner or the affairs of the company were mismanaged during the relevant period, casting a doubt on the reliability of the financial statements. Otherwise, such things cannot be reopened. Accounts cannot be reopened if it's already adopted. It is filed. Income tax has been filed. Returns have been filed. The accounts have been adopted, and we have moved along. So it cannot be, the previous periods accounts cannot be opened because some mistakes were there. It cannot be opened just like that. Okay. So, and it cannot be, one cannot go back. Suppose they want to, certain things have happened that they were, they were not prepared in prudent manner, and it cannot go back to a period earlier than 8 years. Okay, longer than 8 years. So, that needs to be considered. And, okay. And voluntary revision, some voluntary revision of the financial statements on board's report. Okay, that's possible, that the financial statement, it appears to the board that the financial statements of the company or the report of the board do not comply with the provisions of the financial statements and or section 134. There's a board reports and other things. They may prepare revised financial statement or a revised report of any of the 3 preceding financial years after obtaining approval from the tribunal of an application made by the company. So what we are trying to say, under no circumstances, without an approval, closed accounts cannot be reopened. All right, keep that in mind. Okay. So, consolidated CFS, as we said, that it is now mandatory. So, CFS is mandatory, that it must take into consideration all the subsidiaries, okay, of the, parent company or the holding company, and who would have, those subsidiaries would have their own standalone financial statement. So even the parent company would give their standalone financial statement, and then they would have a consolidated financial statements of the all the subsidiaries along with the standalone financial statements of those standalone subsidiaries. Okay, in the same form and manner as it has to be in the same form and manner as guided by the law, which is like say by Schedule 3 now. For all practical purposes, it has to be Schedule 3, whether we follow Ind AS or not. Okay, that's a separate issue, but it has to be dealt with as per the Schedule 3 format and the form. Okay, so and applicable accounting standards. Of course, applicable accounting standards, somewhere it will be in this, somewhere it will be still the accounting standards is. Okay. Specifically, if it is not required, then it is a separate issue. All right. So where it is an exemption can happen, where specifically it is not required, like exemptions for preparation of the CFS, where it has been actually, in writing, it has been intimated in writing, and for which the proof of delivery of such intimation is available with the company, and they do not object to the company for not presenting a CFS. Okay, so it has given to the members that we will not prepare our CFS, and it is a proof of delivery that such notice has been given. Notice has been given and has been received by the members, including those who are not otherwise, entitled to vote, having been intimated in writing. So a notice has gone to all members of the company, and there is a proof of delivery of such intimation to the, with the company, that yes, it has been delivered to all the company, and that they do not object. So it is written like that if you have objection, of course, it will be notified, or we do not get any, intimation from you in writing within so and so time, it will be construed as that no objection of the company not presenting the CFS. It is a company whose securities are not listed. It is not listed. Okay, so the private limited company who are not listed are not in the process of listing on any stock exchange, whether it is outside or inside or in India. So the private limited companies having subsidiaries, it is not mandatory for them to have a CFS. Okay, and it's ultimate or any intermediate holding companies files consolidated financial statements with the registrar, which is in compliance with the accounting standards. Okay, so keep this in mind. You have CFS, it doesn't have to be discussed here in detail, because you have a separate chapter in this audit paper on CFS. So I'm sure there it will be dealt with in detail. Okay, so just for our purpose, keep this in mind. NFRA, we have gone into detail to the extent I think is required for the exam purpose. If you have any specific question, you can ask. Now let's come to the Schedule 3. Now, if you have any question, no question. 2 minutes, please. Okay. Please remember the disclosure under Schedule 3 before we go further. Significance of the true and fair. What an auditor has to report. The auditor actually reports that's a concept of the true and fair, is a fundamental concept in auditing. That's what we need to report, whether we find it as a true and fair. So signifies the auditor is required to express his opinion. So we are giving an opinion as to whether the state of the affairs of the company and the results of the entity is ascertained, and in the course of the audit, it's truly and fairly represented. Everything which is we did the audit, they truly and fairly represented the state of affairs, and they are represented in the accounts, under the audit. And what does that mean? That we have examined. So how do we come to that concept of true and fair? That we have examined, all the assets, and based on the, auditing standards, how we do our audit, that, verified the assets, liabilities, income and expenses, which constitute the financial statements. And no material, and we have taken into consideration that there is no material omission. Okay, no material omission is there, whether in terms of actually accounting and auditing. The all material transactions have been taken into consideration, all transactions in that matter. Cutoff is an important assertion, and completeness is an important assertion, that all transactions pertaining to the company during the audit, financial year under audit, has been accounted for, and within 31st March, if something is related, some transactions are related to 31st March, they has to be accounted for within 31st March, and nothing has been omitted materially. So it is both from the accounting point of view and of course from the auditing point of view. Then only we will be able to say that the, the state of affairs of the company, we can give an opinion of true and fairness of it. And of course, we have gone through all the, clauses so far, which are there in the Companies Act 128, 129 and then 143, giving us the rights and powers that we must have, unless how we verify the, various disclosures, the financial, in the financial statements, the liabilities, assets, income and expenditure, unless and until we get an access to the books and records, which is, again governed by, the book, where the books are available, whether they are kept it, and we have given access to it. Okay. And so books and accounts, where it has to be kept, they have to be kept in the, head office, branch office, or wherever, or they have to be made available. They can keep anywhere. But if it is required for the audit purpose, they have to be made available. And as from the auditor's point of view, we must, be careful that we only call for relevant information and not whatever we think like. Whatever is relevant for the audit should be called for. Okay. So there are various auditing standards being governed when we are giving. We have to take into consideration the auditing standards when we are giving our opinion, like say 700, talking about forming an opinion on the reporting on financial statements, so that an auditor to form an opinion on the financial statements based on evaluations of the conclusions drawn from the audit evidence obtained. So you see, again we are reiterating. Otherwise, such figures which we get to see and then we attest, it's no good. Whether you have all the evidence to arrive at such opinion of the truth and fairness of the state of affairs. That's important, and clearly express our opinion through a written report. So here you see we are consolidating everything what we are learning. That, finally we are attesting the balance sheet and the profit and loss account and the notes to accounts, and so the auditing standards tells us how to do it, and whether we have done it or not, whether, we have all the evidences, and then keeping this in mind, keeping this in hand and making our judgment on the evidences that we collected during the audit. Then you can give an opinion. It is just not a sentence. The truth and fairness of the state of affairs, it's a very big thing. So you are giving an opinion with a full consciousness, and a judgment you're making. So it has to be very careful that we have this clarity in mind with the substantiation of the evidences that we have gathered. Okay. And we have to also take into consideration the accounting principles also. So auditing standards for auditing purpose, but whether the financial statements have been prepared, whether it has been prepared correctly. So for that also we need to know the accounting principles, the auditing standards, and the INDES, whichever is applicable based on its, the company's constitution. All right. Okay. So we'll go into a little depth of the little bit, not much. I'm sure you are all aware of this, but still I would like to take you through a little bit detail of the Schedule 3 of the Companies Act. Okay. Just for a recapitulation purpose, maybe. Okay, so let's come to it. So in part 1 of the Division 1, so we are talking about the balance sheet, where we are talking of assets and liabilities, right? So an asset shall be classified. So here we have we split the asset into current assets and non-current assets. So what are the current assets? For your recapitulation purpose, it is expected to be realized or is intended for sale or consumption in the company's normal operating cycle. Okay? And B, it is saying that it is held for the, being purpose of trade. It is being held primarily for the purpose of being traded and not for as an investment or things like that. Again, investment would have current and non-current, and it is expected to be realized within 12 months after the reporting date. Please answer me generally, of the first A and C, which one do we take into consideration to identify if an asset is current or non-current? Generally. Please answer. Please post an answer. Thank you, Jose. Yes, those who are participating. The last couple of days, I'm getting to see the same names. Yes. Anju, new person I see today. At least, I mean, as far as posting a comment, maybe you were there. I need a answer. Please answer. Which one generally we follow to decide whether an asset is current or not? The company's operating cycle or 12 months? Take a minute and tell me which one generally. Yes, please. That's fine, Jose. Inventory assets being traded. Yes. Give me an answer for which one. I mean, current you will consider. Suppose you have two cases. If you have a case, where such question is coming that, okay, let me put it this way. Let me give you a case study. Current assets, any current asset, stock. Okay, let's take stock. The stock is held for months. In such a case, whether it will be considered as a current asset or a non-current asset, keeping in view that the other parties is expected to be realized or consumed within 12 months after the reporting date. On 31st March 2020, we know that there is a stock, right? There is a stock, and the life cycle and the operating cycle of this manufacturing unit is 15 months. So the management is saying this is a current, and auditor is saying this is not current because it is 15 months. Auditor and the management is saying no, it is 15 months because the operating cycle is 15 months. So it is current. So which one will be correct? What you are saying, the auditor is saying that because it will not be realized within 12 months, that it will not be consumed in 12 months after the reporting date, or the operating cycle of the 15 months. Which one is correct? That's my question. Operating cycle. Generally, yes, Ambika, and you are saying, Nishant, yes, it's if the, Jose, you please remember, if the question comes like that they are specifying the operating cycle, then 12 months will not be considered. If it is, even if the operating cycle is more than 12 months, then it will be what, like say 15 months. That will be, even if it is 15 months, it will be considered as current asset. But your answer will be right generally, because here why we take 12 months in most of the cases, you will see we always consider 12 months. The reason being, we do not know we cannot actually, document justify the normal operating cycle, because it is a continuous process is happening in a manufacturing unit. So that normal operating cycle cannot be justified that, well, it will be consumed in 12 months time even by the management, and hence we generally consider 12 months is the time period, maximum time period for realization or for consumption of inventory, to consider it as current or non-current. The management is okay with their claim. Management may claim, yes Sudhir, management may claim, but you have to be convinced. The auditor needs to convince himself, or the auditor need to be convinced that yes, what the claim is, because management will only tell us. We are not the authority to tell what is the normal operating cycle, but we have to be convinced that what they are claiming is correct. So that justification, if can be, is okay with you, then yes, the operating cycle, if it is more than 12 months, then that can be considered also as the current assets. That is, please keep that in mind for your exam purpose. In case such case study comes, all right, the auditor must be convinced that yes, the normal operating cycle is 15 months. All right. So otherwise it's 12 months. Generally, as you said, Jose, yes, it is 12 months. And if it is primarily held for the purpose of being traded, yes, we consider it is for current asset, but we have to see that yes, it is realizable, it will be traded within 12 months, and we can consider that as a current asset. Cash or cash equivalent. Okay, cash and cash equivalent, it is restricted from being exchanged or used to settle a liability for at least 12 months after the reporting date. So cash is, we know that cash is there, so it is a current asset. And what is a cash equivalent? What is a cash equivalent? Some margin money, which is some, demand lab, something is there with other companies, some earnest money deposit. If it is to be realizable, if it can be realizable in 12 months, all right, that can be considered as current asset. But please keep in mind the unless part of it. Such equivalent cash or cash equivalent is there, but there is restriction imposed on it. Say, for example, a margin money. Margin money is there. It's a cash hold being there with somebody, but it's your cash. The margin money is not considered as the cash of that company who is holding it as a margin, right? So margin money is actually your cash. So can you, now that cash cannot be, you won't receive that unless, before your work is completed in that particular company, whatever way. Maybe this company is doing, supplying something, and it has to be installed, and then the warranty period has to be over, then only it will be realized. So if it is not within 12 months, then it cannot be considered as a current asset. Otherwise, so what we had last part is saying, unless it is restricted from being used or exchanged, that I will not get it, I cannot use it, there is some restriction on it of the use. Okay, to settle a liability for at least 12 months after the reporting date, it cannot be considered as a current asset. If it is, there is no such restriction on the use of such money, it will be considered as a current asset. Keep this in mind, please. Is there for any example for those companies? Yes, many companies can be there who can say this might be, this can be done for any manufacturing unit for inventory, that it will be realized, it will be consumed within, generally, if you see, generally we don't do that, because inventory are defined as current assets because it is a continuous process. Nobody is holding it for, unnecessarily holding it forever. So there are cases. I'll come back to you probably with specific such cases, but there are cases where such can be there. Okay, and even if it is proven that the operating cycle is more than 15 months, relating to what the balances relating to that can be defined as a current asset. I will try to come back with some example. Okay. A liability. Liability is basically, again, whether it is a current liability or not, it will satisfy whether it is again part of the normal operating cycle. It is held primarily for the purpose of trading. It is due to be settled within 12 months, that we will be paying off the creditors within the next 12 months, and the company doesn't have an unconditional right to defer the settlement. Okay. So if we have conditional, we can defer the payment, then it may not be defined as a current liability, but we don't have right to defer it. That will be considered as a current liability. It has to be paid. Please remember, I'm sure you are aware of these since you are going through these current assets and new ledger. Be considered as current asset. Yes, Achyutan, you're right. So yes, you're already, into this. So I'm sure you're aware of this, that we cannot show. I'm sorry. I don't know why the spell check didn't catch this. I'm sorry about it. Net deferred tax. Deferred tax cannot be shown on both the sides, right? Deferred tax liability, deferred tax asset cannot be shown, and it has to be shown as a net. Either of the two. It is either an asset or a liability, and it is always non-current because of its nomenclature, deferred. All right, so it is always non-current. And then we have capital reserve, capital and revenue reserve. The non-current liabilities, disclosures relating to dues to MSME suppliers, employees' benefit. As per AS 15, we'll discuss this. A little bit of these things, we'll discuss this. I'm sorry. Okay. So let's move into this in detail a little bit. So some rounding off, which you are aware of, I'm sure some rounding off takes place. There is guidelines how the rounding off should be done. If it is less than 100 crore rupees, if the turnover is less than 100 crore rupees, it should be to the nearest, hundreds, thousand, lakhs or millions or decimal thereof. It can be in absolute figure also. And presenting it in absolute figure is no problem, but it can be rounded off to this way as been defined in Schedule 3. And if 100 crores and above, if the turnover is more than that, then it is not, then it can be rounded off to, nearest lakhs, millions, crores and decimal thereof. 0.2, generally 2 decimal places, it can be defined. All right, so that can be kept in mind. And it should be uniformly followed. You should be uniformly followed. Okay. Now, it should be to keep in mind. It should not be in T form anymore. It should not be in the T form anymore, and so not horizontally. Basically, the scheduled minimum requirements, basically that it has to be in this format. So I'm sure if you have the books in front of you, you can open the book, please. I cannot show that here. So if you please can open the book, you will see, the format that you are already aware of, the format which starts with the equity and the liability. The equity and the liabilities, and then it starts maybe, in your case study, it may come like that. They will give a small format of the asset side or the liability side, and it will ask you, to identify whether this is correct or not. So that's the reason I'm saying you need to, go through the format also. You need to go through the format which starts with the equity and liabilities. Under that, the shareholders fund should be there. So the nomenclature is very important. This is the nomenclature that shareholders fund is mentioned. And under that, Then comes the share capital, shareholders fund. Under that share capital, reserves and surplus. Then money received against shares, share warrants. Okay. And then this is the way it works. So I've just given you, I'm sure you are aware of, but I'm still giving you a, related, accounting standards here, which governs these balances. Property, plant and equipment, we do not call it, fixed a PPE. Basically, it's a PPE, property, plant and equipment, which is basically fixed assets, but we do not call it as a fixed assets. We now call it as a property, plant and equipment. These are tangible assets governed by AS 10. Then we have intangible assets. We will go into detail each of these to the extent possible. Intangible assets like goodwill, software, etc. Trademarks, licenses, AS 26, capital work in progress, AS 10, which is not an asset, and intangible assets under development again, AS 26, software under development, non-current investments which are being held for trading, all right, and which are held for maturity. Those are non-current investments. Deferred tax, net of it could be liability or a asset. Long-term loans and advances, other non-current assets. Okay, cash and cash equivalent comprises of items such as balances with bank held for margin, security margin, which I already told you, and which will be, which will be recovered within 12 months maturity. Okay, so we have to keep this in mind. And cash equivalents are defined as short-term, high liquidity investments that are readily convertible into cash. Okay, there is no deferment and the insignificant risk of change in value. Okay, that it will be deferred. What is the meaning? What is the meaning of which are subject to an insignificant risk of changes in value? That it will not reduce in value. Neither it will reduce in value nor it will be deferred. For the recovery is not deferred. So then only that such risk is very minimum, insignificant, and hence can be constituted as, cash equivalent. Investment qualifies as cash equivalent only when it is held for short-term maturity of 3 months. Please keep that in mind. So if it is held for trading, it is a non-current assets like, within 12 months. But if it is even shorter, maturity of 3 months or less from the date of acquisition, that can be, termed as a cash equivalent. All right. And contingent liability and commitments, we know they are contingent in nature and are not, forming part of the financial statements, but they are not part of any account balances, because the simple reason they are have not been realized, whether it is being a liability or a commitment. It is still not realized as a actual liability, and hence is not accounted for there, but very much part of the financial statements as a disclosure of what is a contingent liability and commitment. All right, for the stakeholders to know, which we have discussed. Why do we have to give these information for the stakeholders to know about the state of affair of the company that is going to unfold, or what it is already going through. All right. Any question? Any question? No question. If you have any question, those who have opened the, would request you to open these schedule through guidelines, or which is there with your study material. It is, you can open the study material. Okay. So share capital. So if we come to the share capital, yes, capital and reserves. So first thing is here, share capital. So certain things you have to provide there, disclose there, and the company has to disclose there, and auditor has to ensure that it is in that format. Number and amount of shares authorized, and number of shares issued, subscribed and fully paid, subscribed but not fully paid, and per value per share, and reconciliation of the number of shares outstanding at the beginning and at the end of the reporting period, and the right, preference and restrictions to each of the class of the shares. So there are certain, guidelines, the way the share capital has to be reported or to be presented in under Schedule 3. Okay. Where I'll just tell you about the important areas. All are important. These are mandatorily have to be reported, where depending upon their applicability. So share held by each shareholder holding more than 5% shares, to specify the numbers. If it is more than 5%, if somebody is holding more than 5% of the shares, so how many are there being held by that person or persons, it needs to be reported. Shares reserved for issue under options of the contracts, or commitments for sale of shares, disinvestment, that has to be reported too. And for the period of 5 years immediately preceding the date as on the balance sheet period, aggregate number and class of shares allotted as fully paid pursuant to those things. Under that if it is under contract, that it has to be, given. So the shares to be given. So for such cases, for such a case, the details of the preceding 5 years data needs to be produced. Okay, like as say bonus shares and things like that, bought back shares that have been bought back. Then you have to also give the convertible terms of securities that are convertible into equity or preference shares, if something like that is there. Calls unpaid, forfeited shares, these details need to be given. Okay, these needs to be given on the face of the balance sheet, whenever it is applicable. Okay, then comes the reserve. The reserves and surplus, there are several types of reserves. Okay, there are several types of reserves there. The capital reserves, the capital redemption reserve, securities premium has been received, so that has to be kept separately. So securities premium reserve, debenture redemption reserve, debenture has been issued, redeemable debentures have been issued, so they have to be repaid. So a separate reserve has been created for that. Debenture redemption reserve, revaluation, asset has been revalued, and based on that valuation, so that can be the extra value that has come out because of the valuation, so that has to be kept as a revaluation reserve. And share options, outstanding amount, that has to be separately kept also. And surplus, that is the balance sheet state, profit and loss of allocation, which is meant for distribution of dividend, bonus share, and things like that. In case of reserve specifically represented by earmarked investment shall be termed as the fund. Okay, so we have what we have to pay out. What we have to pay out for the say in case of debentures or the securities, in terms of say capital, shares have been had taken a premium. Shares have been sold at a premium, so that has to be kept as a separate fund. Okay. Debit balance, in case there is a loss in any particular year, that has to be shown as a negative figure under the surplus. Okay, as a negative, it has to be deducted from the surplus. Okay, after adjusting so it should always give the net balance. Okay. Which one should be it should be Ind AS and not AS. Which one, Nissan? I didn't get you, Nissan. If you can clearly tell me, I will understand it better. Ind AS is not applicable everywhere. So, but Schedule 3 is mandatory. That's the reason Schedule 3 have two divisions. One is for Ind AS, one is for the normal accounting standards that is still prevalent, which are for the companies who are not coming under the purview of Ind AS. Okay, so I didn't get your question correct. So if you can tell me, probably I'll be able to better explain. Okay. The long-term borrowings, because you see, this I have not copied as it is from the study materials, because otherwise the presentation would be too big. I would request you to look into the study material, because let me explain and not just be there, so you won't find much of content here, so that's all. I mean, basically I'll come only to the dividend and depreciation later, but not before I go through the Schedule 3 requirements. Okay, briefly, not in detail, very briefly. Okay, so then the long-term borrowings. If you see the balance sheet after the shareholders fund, then after the shareholder funds, then come these shareholders fund. It comes then. After that, it comes the reserves and surplus, shareholders' capital, the reserve and surplus, money received against share warrants. Let me just explain, because here you have received the money. The company has received the money for share allotment, but share allotment has not been made. It has to be separately disclosed. It cannot be merged with any reserve or in the share capital, because share has not been allotted. But they have received the money, and to that extent a warrant has been given that a share will be allotted. So that money received against the share warrant should be disclosed separately, for which share has not yet been allotted. All right. That's the share application money pending allotment. Okay. Then comes one is the money received against share warrants, and the application money received for the pending allotment. Only the application has been received. So please remember the two things. What difference between the warrant and the application pending allotment? Okay, it may not be allotted. What happens in case it is over subscription has happened? It has to be returned. So, but till such time it has to be shown. All right, and it has to be returned within a given period of time. That's a separate thing. But warrant is that it has been allotted. It will be given. It is for sure, but not yet been share certificate has not yet been given. Long-term borrowings. So non-current liabilities. Under the non-current liabilities, then comes under long-term liabilities, non-current liabilities. What are the components? The long-term liabilities, the deferred tax liabilities, the net. It can be there in the deferred tax asset also, but we are talking here if in case it is a deferred tax liability is more of the net of asset, that should be under the non-current liabilities. Borrowings, other long-term borrowings, long-term provisions. Okay. So what are these? Let's look into that. What are these? So these basically contains the bond and the debentures. Okay. Bond and the debentures, which will be refunded at a later point of time, after 12 months at least. After 12 months at least, that's why they are non-current. So keep that in mind, the basic thing about that period. If it is more than 12 months, it has to be non-current. Term loans. All right. Term loans which are for more than 12 months. Okay. Repayable after, say repayable within 5 years. Okay, after 5 years, moratorium is going on. So it has to be a term loan under non-current liabilities. Okay, so from banks, from other parties, deferred payment liabilities. Okay, deferred payment liabilities like what? What could be the various deferred payment liabilities? Any idea? Yeah? Can you post an answer? Some tax maybe? Immediately do not have to pay? Okay? Uh, if you have a question, let me answer that. You are saying, Jose, you said about the coming, it's not, it is related to the preceding years, not for the future years. Okay, it is all related to the last preceding 5 years. Okay, disclosure is for the aggregate number of shares and not related to the, coming years, preceding the balance sheet date. Okay, event has already occurred during a period of 5 years immediately preceding. Yes, please. No, it's okay. Or okay, ठीक है, let me take a break for 5 minutes. Okay. Yeah. Okay. Dear students, coming back to the question of Nishant Kajaria, well, in this, you have to be very, I don't know, there's some confusion, my dear Nishant here. It's not completely replaced. Both are there. AS and INDES, both are there. So, Schedule 3 is compulsory. Schedule 3 is mandatory once the Companies Act came into 2013 came into being in 2013. Schedule 3 is mandatory for all the companies to follow, but not in days. So there are certain companies who are, as I told you, who are the companies who should be following in this. And other than that, say for example, the private limited companies who are not within the threshold, they will be still following the accounting standards. So we have division, division 1 and 2, and division 1 talks about the, the non-index, and division 2 talks about the index. We will not discuss the index because you have a separate, paper on that. FR. So the audit paper is not discussing that anymore, and which I believe in Inter also you have gone through the accounting standards. So for only touching upon the areas for your exam purpose, in case the MCQ comes, where there you should not be confused. The statement is talking about what? There, first thing you have to identify whether it is falling under division 1 and division 2. Otherwise, there will be an error. Okay, so please let's not be confused about that fact that both are applicable. Say for example, for the listed companies, index is applicable, yes, but for the unlisted and private companies who are not falling under the certain threshold as defined, so they are still following accounting standards. But yes, Schedule 3 is mandatory. That's why I'm again touching upon the areas for the disclosure that is required in the Schedule 3. All right. So schedule. So don't if in case study, if it comes like a T format, so that is absolutely incorrect for any company, right? So that's mandatory that we have to follow Schedule 3 format to the extent it is applicable. The content will vary from company to company. In case it is they are there, it will be. It should be disclosed. If it is not there, it should not be disclosed. So we are just talking about that, So I think you should be careful about that part. All right, let's move. I'll quickly take you through this. So the reserve, basically, I discuss the reserve. Okay. Debit balance, yes, I have discussed that. You can, if you need to, you can always go back to the guidance notes of the institute, which is already also in line of that. Your study material is also provided. You can go through it in detail, but just for understanding purpose a little bit, I'm taking you through this. So the long-term borrowings that we were discussing, okay, long-term borrowings, bonds and debentures, including along with the rate of interest and the particulars of redemption of conversion, as the case may be, should be stated, okay, in the face of the balance sheet. And so, long term has not been defined though the phrase long term has not been defined, but we go by the current and non-current. So if it is not to be refunded within 12 months, it is non-current, otherwise it is current. So if it is to be refunded within 12 months, it should be disclosed as current liabilities. Okay. Like cash credit. Cash credit is generally, renewable every year. So it is less than, so there you have to be very careful about it. And but term loan is different. Cash credit, overdrawings, overdrafts, these are not covered. So they are not covered under as per the term of term loans. Okay, generally they are basically strictly for a loan for a fixed period, for a fixed amount and for a fixed period. End user fund is for a fixed term and period. So that we have to keep in mind. Deferred tax liability, as I said, many of you said yes, the GST. It could be, the earlier it was VAT, deferred payment for some acquisition of property, plant and equipment, some intangible assets that we do not have to pay immediately. If such kind of deferred payment liability is there, that can be defined as a non-current liability also, and doesn't have to be necessarily under the sundry creditors as current liabilities. Okay, keep that in mind for your exam purpose. Similarly, we have some other long-term liabilities, trade payables and others. Okay. So payables would be like that. If it is to be paid after 12 months, it can be can be non-current, and like say for example, under contractual obligation, the payment will be after 12 months. So it doesn't have to be defined as a current. It will be as non-current, and it should not be taken in the trade payables. Okay. It could be because of the statutory obligation, again for acquiring plant, property, plant and equipment, intangible assets and things like that. So it should be accordingly disclosed. So why I'm discussing a little bit, though you are already aware of this from inter time, I'm just disclosing it, telling you this so that you remember for your exam purpose, because this 30% at least will come. Will be MCQ, so that you do not get confused in the MCQ. MCQ, as I again reiterate, you need to read the between the words to identify, and these could be the small things which we may overlook. All right. Here we have to also take into consideration the MSME guidelines, that whatever trade payables, whatever the payables, whether it is a long term or short term. Trade pay for MSME, it is always a short term because it has to be paid within 45 days, and hence should be clearly mentioned. It should be clearly mentioned unless and until it is contractually or some obligation is there where it can be later. So that should be given properly, that how much is due out of the total payables, how much is due to the MSME. Suppose something has not been paid. Something has not been paid. It's supposed to be paid within so and so period, but it has not been paid. So it has become non-current. Okay, it will be paid after 12 months. It will be paid after 12 months. They have decided to pay after 12 months, setting aside the other legal requirement. So in that case, it has to be clearly defined that how much is due to the MSME vendors. Okay, so that disclosure is important, including the interest, because if MSMEs are not paid on time, some interest will accrue, and that disclosure should also be there. Okay. Long-term provisions here. So what are the long-term provisions that will be, right? Employee benefits, and all are not short-term. Can you tell me some short-term employee benefits? I think I got an answer. Say bonus you have to pay, immediately within 12 months of the provision. So that's a short term, but long term could be retirement benefits, post-retirement benefits and things like that, for which like gratuity and things like that we will not accrue immediately within 12 months. But there a bifurcation has to be done. The employees who are retiring in the next 12 months, for them the benefit has to be disclosed as current and not as non-current. Okay, so those kind of things must be taken care of in the long-term provisions and things like that. So AS 15 guidelines has to be, accounting standards has to be dealt with properly in this. So this could be one of the area for getting an MCQ question. Okay, keep that in mind. Okay, since you have gone through this in inter, we are not going through in detail. So it is expected that you are aware of it. Okay. Then comes the current liabilities. So once that is done, now come to the current liabilities. Shareholders fund, long-term borrowings are gone. Now coming to the current liabilities. What are the current liabilities? The short-term borrowings. Short-term borrowings could be the cash credit and things like that, which is, payable within 12 months after the balance sheet date. Trade payables, of course. Total outstanding due to micro and, MSME, we have to, again, here also you have to classify. Please keep that in mind, whether it is in the long term, if you have not paid something for the MSME and will be paid, it is decided to be paid after 12 months, keeping aside the legal requirement of the MSME Act. So we have to, disclose it separately along with the interest that is to be paid to the MSMEs, vendors, and for the current liabilities also of the trade payables, how much is for the MSME and how much are for the non-MSMEs, that needs to be disclosed. So MSME disclosure and trade total outstanding due to the creditors who are other than the MSME vendors, okay, and other current liabilities and short-term provisions and the liabilities. Okay, so these kind of things you must keep in mind, and I'm very sure you are aware of the difference between the liabilities and the provisions. So keep that in mind for your exam purpose. Okay, short-term borrowings could be from the, the loans that are repayable on demand, cash credit. Okay, cash credit. So they generally are renewed every year, but there could be such cases where it need to be repaid. So from banks and from other parties, which are, basically are to be repaid back on demand. So we need to keep that in mind. And loans and advances from the related parties, they are defined as the short-term borrowings. Deposits, if taken, there are a whole lot of, prohibitions on taking deposits, but keeping that prohibitions in consideration, deposits can be taken. So if it is a short-term in nature, they should be shown as a short-term deposit. And other loans and advances, we need to specify if it is not falling under any of the above. Okay, borrowing shall be subclassified as secured and unsecured. This we are aware of, that it is, and because we need to tell what security has been provided. All right, what security has been provided to take such borrowings. Okay, so it needs to be classified under secured borrowings and unsecured borrowings, and nature of security has to be specified separately. Okay, where loans have been guaranteed by the directors and others, that needs to be disclosed separately. And in case of any default has happened, period and amount of the default as on the balance sheet date in repaying the loan and the interest should be specified separately in each of such cases. So you see the Schedule 3 requirement for the disclosures are very detailed, and if the reason being the stakeholder should come to know the detail about the affairs that's going on into the company, whether he is interested or not. He may be interested or he may not be, but stakeholders will get all the information, whether it is a banker, the member, private limited company. It may not always be the, it's only the member, but what about the banker, right? So those kind of things are important. So if from the face of the balance sheet, it will come to know, the banks will come to know, you see what kind of borrowings are there with the company from other banks maybe, or from directors maybe. So such disclosure are mandatory. Okay, so as an auditor also, we need to keep that in mind. Okay, so item-wise default we have to give. Trade payables, we know the trade payables that sundry creditors basically, okay, and other long terms also, whether we have to decide whether it is payable within 12 months, it is long term. If it is not, it is current assets and current liabilities, under the trade payables. Other current liabilities, current maturities of long-term dates, it could be there. Maturities of finance lease obligations and whole lot of things. Interest due and accrued, interest accrued but not due on borrowings, okay, and interest accrued and due on borrowings. So these are the important things that we need to disclose, because interest is payable immediately, right? We need to remember that interest, when somebody is borrowing term loan, say for example, term loan is non-current. if it is repayable after say 5, not repayable within the next 12 months. But interest is payable as and when it falls due. So we must keep that in mind. So interest cannot be also termed as a non-current. Okay, depending, the general rule is that interest is to be paid as and when it is due. And interest on banking borrowings are generally they fall due every month. That every month the interest is calculated and is the borrowers supposed to pay that, and naturally it has to be accounted for. That interest accrued but not due. As on 31st March, suppose the payment falls due on 15th of April. But as on 31st March, to the extent it has been, that apportionment has to be done. So it has not become due, but it has accrued up to 31st March. Whatever is the balance, we need to take that apportioned and take that into consideration into our accounting and of course into the disclosure. Please keep that in mind. And if it is falling due on 31st March or before, it should be disclosed as interest accrued and due. Maybe it is, due on 1st of March. So that needs to be naturally disclosed if it has already not been paid. So that's interest accrued and due, and interest accrued but not due. Okay. Income, interest accrued, interest received, income received in advance, payable. Okay. So whether it's a short term, long term, one has to keep that in mind. Depending on that, the disclosure, accounting will be done and disclosure will naturally take place. Unpaid dividends, it is always the other liabilities. It is immediately payable within 30 days. So it is not a non-current, it is current. Okay, dividend becomes payable within 30 days, right? So, and it has to be considered as current liability, whatever remains unpaid. Application money received for allotment of securities and due for refund on interest thereon. Okay, unpaid matured deposits, which have matured but not paid for whatever reason, and interest accrued thereon. Unpaid matured debentures and interest accrued thereon. So please keep in mind, when we are talking of the debenture, it could be long term, it could be short term, but matured debenture not paid. All right, so it is unless and until there is some deferment, unconditional deferment clause lie with the company, it is current liabilities. Okay, and other payables, whatever, it needs to be specified. If it is not falling in one of these, it is quite exhaustive. Even after that, if something cannot be put under any of these, it should be reported with details. It cannot be just like that. Other payables, the details should be provided. Other is not good enough. We need to keep that in mind. Other non-current liabilities like, statutory dues like the taxes, excise duty, or, it used to be excise duty, GST, employer-employee contribution for PF, ESI, and, those kind of things should be taken into consideration as other, current and non-current liabilities, depending upon the time period in which it becomes, the company becomes liable to pay. All right. So keep that in mind. Short-term provisions could be for employee benefits. Say, okay, short-term provisions, others we need to specify. So keep this in mind. I'm just going through this very quickly because you are already aware of it, just as a, recapitulation purpose for your exam. And in case you have any specific, you can post the answer. If I can't answer you right now, I'll definitely answer back. I don't think I have not answered. There has been no cases where I have not answered. All right. So I will keep up that promise. So you please post in case you have to go through this. And those who have gone through it, you can post your answer question. Those who are going through it, please, if something is not understandable, please post the question. We'll surely get back to you. Okay. Then coming back to the asset part of it. So similarly, non-current assets. What are the various non-current assets? So again, it is basically current and non-current. The current, we have explained what it is, keep that mind for your MCQ, or generally for a theoretical question also. There you have to clarify more in detail with, you have to give in theoretical questions, it will be more of clarifications. So more you can write the meaty substance, not whatever you think you write, but if you write the proper explanations giving out these, specific from these areas that, this is what is called a current asset and a non-current asset, naturally you will be able to score more. Non-current assets, it is expected to be realized within 12 months or normal processing cycle. Okay, so those are cash and cash equivalent. So, this is, please, you can open your book and see that it is generally given in form of, this way, property, plant and equipment, and intangible assets, capital work in progress, intangible assets under development, current non-current investments, deferred tax assets. We had saw the liability net, keep in mind, long-term loans and advances and other non-current assets. Okay, so, and it is guided by the various accounting standards for non-Ind AS cases. Okay, so what the property, plant and equipment says, PPE. So there we have to go by the Schedule 2. Schedule 2 is the guiding factor. Okay, guiding factor here is the Schedule 2. So we should disclose, the company should disclose the information about the property, plants and equipment as per the, format given by the Schedule 2, which talks about the land, building, plant and equipment, furniture, fixture, vehicle, office equipments and others, and please nature, and asset under, asset under lease should be separately mentioned. Asset under lease should be separately mentioned. And the reconciliation is the opening balances, addition during the year, which has been sold during the year, and the closing, the depreciation and the carrying cost. So this is the way the format is, which is, which very well. Such things should be there. Addition, disposals, acquisitions to business combinations. It's possible the merger has happened. That has to also come into additions, things like that. And the related depreciation and impairment losses. Not to forget the impairment of assets, right? Which is, again, accounting standards, and in this is also there. So impairment of asset is happened. If it has happened, that has to be also there, forming part of the Schedule 2 format. Okay, in case such thing is there. Okay, keep this in mind. Okay. Anything else? If you have any specific question, you can put in. I will answer. Otherwise, I'll move forward. Okay. Otherwise, I'll move forward. Okay. Intangible assets. Intangible assets are basically, we are talking about the goodwill, the trademarks, which has been acquired by the company, the computer software. Software are not written off in the same year because it has its life. And which will be written over a period of time. It includes amortization also. You remember, computer software should be taken into consideration as part of the intangible asset, and the titles, mining rights and things like that. Recipe copyrights, recipe formulas for some manufacturing units into who are. I mean, I don't have to name a company who's into such manufacturing of fast-moving items, so they would be having, all of them would be having, some recipe, and they are their asset. They are basically their asset, and designs and models, and license and franchises, and if anything else that are not falling under this category can be disclosed, and which has a quantifiable amount, can be associated with that. Of course, can be associated with that, and a reconciliation also. A reconciliation of the gross and the net, carrying amounts of each class of assets as above should be given. Actually, the disclosure of profit and loss account is not correct, so it needs to be amortized. All right. So just an example. Just actually whether it is depreciating. Here we are meaning it is depreciating because this is not a physical asset. We are not using the word depreciation. We are amortizing it. But because they also have a longevity, they cannot last forever unless and until it lasts forever. a title has been acquired and it will last forever. That's a separate issue. But, where it has to be renewed over a period of time, trade license has to be renewed over a period of time. So if it is for a 1 year, every year, we don't really capitalize it, do we? We don't capitalize it. If it is a trade license which will continue for several years, then only we amortize it. Why should we take the cost into 1 year? And the profit will naturally be not showing correctly. So that's the judgment, that what is the longevity of that tangible asset. That's what an examinee should keep in mind. Okay, that you should keep in mind. Based on that, the amortization. Now, the period of amortization is also important. Somebody will say, we'll amortize over a period of 10 years. Now, you have to accept it. You have to understand, that auditor must understand that, will it last for 10 years? If it doesn't last for 10 years, no, it has to be amortized much before that. So, again, useful life. Useful life here is the most important aspect of the, matter. Useful life. Okay, which we will just deal with in depreciation. Okay. Capital work in progress, which cannot be capitalized because it is still, but it has to be substantial expenditure has happened from the company. So where the booking will go, there is always the both sides. So where are you booking? You are making an expenditure, but where will that booking go? Will you capitalize it? No, it is not capitalized because it is not put to use. Basic fundamentals, it is not put to use. So then it cannot be capitalized. So it will be kept under capital WIP. And no depreciation will be naturally not charged, but they will be shown in the schedule 2. Okay, and okay, so those things should be kept in mind. Capital advances, keep that in mind. Yes, it's important. Capital advances, would you put that as capital work in progress? Advances have been received, or had been given. Advances had been given. In this case, advance had been given for to the vendor who's actually doing the work for this asset implementation is going on. So this will not be considered as capital WIP. It will be a long-term advances, all right, which will be actually adjusted after so and so period, which will be adjusted. So at the first, when somebody starts the work, he should need a mobilization advance. Okay, and which will be adjusted with the bill which he submit after, say, after 1.5 years or 2 years. Okay, so that will not be a capital asset, capital WIP even. That will not be a capital WIP. It is a long-term advances, loans and advances. It is not, for this particular example, it is not a loan, it is an advance. Okay. Similarly, intangible assets under development is also to be taken into consideration. Okay. So, how much has been completed? How much work has been completed? How much work has been completed? Suppose the software is under development. Software is under development. How much work has been completed? To that extent, it should be kept into capital WIP. If it is not there, it should be, if any money has been paid, it remains as advance. And it is guided by the accounting standards. Non-current investments. Non-current investments are which are not held for for trading or short-term basis, as we explained. Are like investment in property, equity instruments, preference shares, government trust and bonds, which will be government trust and bonds, debentures. Like this will mature not immediately, not in short term. If they mature in short term, we put it accordingly under current or even cash equivalent if it is maturing within 3 months. But if not so, they will be non-current investments. Okay, mutual funds, in partnership firms, whatever. So there are a whole lot of explanations which will be non-current investments. And the following should be disclosed. What are the things? Aggregate amount of the quoted investments and unquoted investments. That's important. Quoted and unquoted investments. And we have to also take into consideration the provision of diminution in the value of the investment. These 3 things we should keep in mind. The quoted investment, the unquoted investments, and the diminution. Permanent diminution in the value of the investment. When do we account for it? We account for it only when there is a permanent diminution in the value of the investment. Then only we account for it. Keep this in mind. Okay. So generally, investments are required to be carried at cost. They are carried at cost. And if there is a decline, other than temporary, that means it is permanent in nature. In the long-term investment, the carrying amount should be reduced to recognize the decline. We have to read the question properly. So if it is in a temporary nature, you may choose to ignore. If it is not, then we have to reduce the cost of the investment by the decline in the value. Okay. So it should be carried at the cost less the provision other than for the temporary diminution. Okay. Quoted, unquoted, which is quoted in the exchange, stock exchange. The unquoted, they are unquoted shares. So accordingly, it will be taken into consideration. Appreciation, we do not take. Okay, appreciation, we do not take. Diminution, we take into consideration. Long-term advances. Long-term advances, loans and advances, what are they? Capital advances, as we discussed, security deposits, which will, which will mature only after the end of the term, say 4 years, 5 years. Security deposits, we are doing some work, the company is doing some work, and for that a security deposit has to be paid, which will be funded only after the completion of the work, which is, say, after 4 years. That will be considered as the long-term advances. Similarly, capital advances, if some capital work is going on and we have given some advances to the vendor, so that will be considered as capital in nature. To the related parties, giving their detail, if it is related to the given such advances to the related parties. A related party could be another company from whom we are purchasing materials and things like that. For that, we have provided, advance. So that, and in a long-term nature, which is in long-term nature, that needs to be disclosed. That advances will be adjusted later on. So it should be, with the detail, it should be given. And other loans and advances as per the, and you have to specify the nature. So it should be classified, whether they are secured or unsecured and doubtful. The moment we come here, the moment it is related to the asset, it is very important to give whether it is in secured nature of, whether it is a secured in nature, whether it is unsecured, and whether it is doubtful. Unsecured doesn't means it is not good. So unsecured but considered good, and doubtful. Okay, so it depends on the period, a whole lot of things which as an auditor I'm sure you're aware of, that we have to again here use our judgment that some data balance is probably lying for long, and they are or advances is lying. You have given the advance, and it is not secured. I mean, you are getting a software developed. Let me take this example. You have taken your software is getting developed, and the time provided was that we will be completing it. He says that it will be done only after 2 years. All right, and we need some advance for that. So that advance has been provided, and because it will be only adjusted after 2 years, it is coming as the loans and long-term advances. Now, but what is the security? You have not taken any security from the company. So if you have not taken any security from such vendor, it will be termed as unsecured. But how to consider whether it is good or doubtful? Now that then you have to see into the detail, like, are the companies delivering the software as explained? There should be a milestone, or if it is any other capital, capital item, PPE. So are they delivering as per the milestone? If the milestone is such that the entire delivery we will get to see only at the end of the 2 year, there probably you cannot decide it as doubtful. Then you wait for 2 years. Okay, that's a basic fallacy probably. So we have to for an auditor to consider whether it is doubtful or good for an unsecured, advances and loans. That what are the milestones given for the recovery or adjustment? Recovery in case of loan, and advance, it is adjustment. So what kind of, milestone has been given? That after 6 months, you have to give us this report to show that how you are progressing. Or in case of a capital, in case of a tangible asset, in case of a tangible asset, you get to visualize. In case of an intangible asset, you can't visualize, right? A software you can't visualize unless and until you get to use the product. In case of a, tangible, you get to see. So can you see it? Or do you have a report to be convinced that yes, they are progressing as per the schedule or the milestone? If it is so, then the auditor makes a judgment that it is, yes, though it is unsecured, it is good. But if such things are not there, suppose in 6 months' time, the tangible asset is supposed to come up to 1 story high. The building is being constructed. Within so and so time, the plinth should be there. And even after 12 months, when you have gone for the audit, the auditor sees that even after 12 months have passed from the milestone, nothing has come up. So then it would be a skepticism again. We have to decide and talk to the client and find out whether it is really to be considered as doubtful in nature. It might come out that he is not there in business at all. He has gone. He is not traceable. Or there could be some other reason, like, it is a pandemic situation. Like, just see, for the last 6 months, it's a pandemic situation, and hence the construction work is stopped. Maybe from, August or July end, and August, slowly, it has started happening. So when an auditor goes for the audit in 2021, the milestone which naturally be pushed back, naturally will be pushed back, whether documented or not. So we have to use that judgment that we cannot consider, for this case at least, we cannot consider such advances as a, doubtful and unsecured and doubtful. No, we can't do that. So we have to, and if it is secured, then it's secured and considered good, because we have the security. That's why such kind of, margin money is guarantees are taken, bank guarantees are taken, so that in case something goes wrong, that can be invoked. So if security is then there is no problem. If security is not there, then we have to look into details of this. Okay, keep that in mind. And if it is found out that yes, it is in doubtful nature, whether provision should be made or not. Okay. Prepaid expenses are, advanced tax, these are all depends on when you are actually adjusting. GST credit receivables, these could be termed as other loans and advances, depending on the period, it will be long term or short term. And if it is to be expected to be realized within 12 months, it can be definitely considered as a current. Okay. Some other non-current assets. Okay, some other non-current assets like deferred credit terms, long-term trade receivables, and where it is said that it can be paid in tranches. The payment will be in tranches. We have delivered the material, but the receivable will not come in one go, but it will be paid in installments, in installments. So if such installment is falling, due after, say, the threshold of the 12 months, it should be accordingly disclosed. Secured, and again it has to be long-term trade receivables should also be disclosed as, to be separately disclosed at whether secured considered good, unsecured considered good, and doubtful. That has to be done. Okay. And this includes debts due by the directors. So similarly, current assets can also be, current investments, and current assets can include such investments which are maturing within 12 months or so. Accordingly, it can be defined. I think I have told you about this several times, so it's okay. What are the other things that should be taken into, current assets? Inventories, like raw materials, work in progress, finished goods, stock in trade, stores and spares, loose tools, etc., goods in transit, and so these should be taken into consideration as the inventories. And trade receivables, again, as we have seen in case of non-current, similarly it can be current and split into that secured, unsecured, and unsecured considered good and doubtful. Cash and cash equivalent, we have explained. I have explained. So yes, contingent. So contingent liabilities and commitments. Contingent may be classified as claims against the company which has not been acknowledged as debt. Okay, claim has been made against the company, not acknowledged as debt. Guarantees given by the company. So guarantee will only become liability when it is invoked by the party to whom the guarantee has been given, right? So till such time it remains as a contingent liability. And commitments. Okay, commitments like estimated amount of contracts remaining to be executed on the capital amount and not provided for. Those can be commitment that are committed to complete it. So uncalled liability on shares, other commitments, and we have to specify the nature of such. And Accounting Standard 29 deals with such provisions, contingent liabilities, and assets, as the case may be. So, okay. If you have any question, tell me. Then otherwise, I move to profit and loss account quickly. Can you please touch upon the trade payables? Ari Bapri, you have a lot of questions. MSME is basically trade payables. MSME is Ambika. MSME is a category. It's a category. So companies falling into that category take a, they have to be empaneled, or they have to be they have to take such kind of a registration, not empaneled, I'm sorry. They have to take such registration, and then only they become an MSME, vendor or a vendor. And certain payment rules are there that you have to pay within so and so period of time if it's an MSME. And if not paid within such time as specified, 45 days or so, if I can recall correctly, then interest on the payable has to be calculated. Okay, interest has to be, I think it's again a simple interest has to be calculated, and so it has to be taken into consideration that. So what it means for a company having MSME vendors. It is absolutely important, mandatory, that the MSME vendors must be identified in the company. Maybe a company has 1,000 vendors, right? So out of that, maybe 100 vendors are MSME. So they need to be identified, and system should be such, internal control system should be such, automated or manual, it should be such that, a list of payables within that given period of time should be reported as part of the MIS to the, to the manager or whoever, supposed to get the MIS, so that the payment is made within the given period of time. So those things are important to note. So unless and until MSME vendors are identified, they won't be able to define this rule in the system. And without defining such rule, it is very difficult to follow the rule. All right. So these are implemented through systems in most of the companies, in large companies, medium to large size companies. These are implemented into the systems that they are identified, and naturally the payment due becomes for other vendors, the payment may fall due after 3 months. It's possible. 3 months credit, 3 months credit is given by that vendor. That's possible, but not so in case of an MSME vendor. So how the system will distinguish whether the payment is falling due after 3 months or within 1.5 months, depending on this classification. So it has to be paid accordingly. Cost audit in detail. Okay, we'll come to that little later. Leave encashment, yes. Whether cash, credit, due are always short-term or short-term borrowings. Short-term borrowings, yes. Short-term borrowings, because it is renewable, it is payable within a year. Cash credit, yes. Leave performance, yes. Leave encashment, Leave encashment is generally, it depends when it can be encashed. So if it is encashed within the 12 months, it is a short term, otherwise not. Performance bonus, these are generally, you see, these are, 1 AS15 is applicable, and of course, whether it is to be paid. The consideration here is how often it will be paid. So leave encashment and the performance bonus are generally paid every year. So naturally, by virtue of that, it is falling due within the next 12 months, and hence it will be current liability. Again, you see, Jose, it will depend whether you are classify the advance received from creditors. Okay, that's payable. Creditors advance received from the it's a payable. Okay, so and the receipt from the debtors. Debtors is this is payable. Advance received from the debtors, which you have received from the debtors, is payable. So that will be, so all depends, and creditors will be given to the creditors. You have said that received from creditors. Why would creditors, whether to classify advance received from creditors? Why would creditor give you advance? You generally give advance to creditors, right? Then it will be as if you have taken, I'm not understanding. So I'll probably we need to speak into this a little more. Okay. Disclosure, Joe's tangible assets written off. Yes, disclosure will be there that it is written off in 5 years time. Yes, amortize how far? What is the amortization period? Amortization period, that is defined because schedule 2 gives you for the tangible assets when it can be depreciated, and here it need to disclose if it is over a period of how much period of time, over a period of what time you are amortizing it, that has to be disclosed, as in the case of the tangible assets also. If you are depreciating which is not in line with the what is defined in schedule 2, that needs to be disclosed separately with justification. So it needs to be disclosed. Yes. Is Ranjit, you are right. I mean, for the detail part, I'm not going to into it, whether it has to be, of course, it has to be filed, register. A party has to be registered. So whatever relevant file form he has to file, he will do that. I'm not going into that. But what I'm trying to tell you here for the, as far as the balance sheet and, financial statements disclosure concerned, is that whether how much amount is due, because of it, the stakeholder would come to know that MSME, there is a separate, legal requirements for the payment to the MSME. You cannot they cannot give you too much of credit line because they're small and medium sized vendors, right? So they need to be paid. They need to be paid fast. And if the disclosure is correct, the stakeholder comes to know that if such payment has been made within time or not within time. That's the requirement. That's the requirement. Okay. And yes, it should be inbuilt into the internal control system so that payments are not forgotten. Payments are not overlooked, which are actually required by the Act to pay within a certain period of time, which is not so in case of the other creditors. Like say a creditor can give you that will be defined. What you pay to the other creditors who's not an MSME, that will be guided by the contract. You might have a contract. It's not that you do not pay. I'm not saying that. What I'm saying, it might be guided by the contract with the vendor. You have a contract with a vendor that I'll purchase from you and I'll make a payment after 3 months. You have to give me three months credit line. Similar contract can be with the company who's serving as a customer, right? A contract with the as a seller, as a seller. So they can also have a contract like where that you pay us, the customer will pay you. Here the company is a vendor. So I'm selling. So the purchaser, who's actually my customer who's purchasing from me, he will say that we will pay you only as per the contract. Okay, that's fine. But if the company is an MSME, by default, by the act, it has to be paid within a given period of time. That's why it has to be taken up specifically. No other reason. But for the other cases, it has to be as per the contract. Okay. And naturally, because if you do not get the payments over time, if you see when it becomes doubtful in such cases that it is supposed to be paid or received in 3 months' time, but you are not receiving that even after 3 years, then only it becomes doubtful, right? So these kind of things must be there to substantiate the fact whether, a debtor or a creditors will be considered as, doubtful or otherwise. Creditors with debit balance. Yes, that's what. Yeah, now I am getting it. Good. You are saying creditors with debit balance due to return or damages. If creditors turns out to be having debit balance disclosed under, okay, where it is to be disclosed. Okay. It is having a debit balance, yes. Because you are not paying. You have already creditor with a debit balance because due to the damages or the returns an adjustment has not been made. Again, it depends on the time. It has to be shown accordingly. Yes, it has to be shown in the asset and the liability accordingly. You cannot net it off. Yes. And I think you are saying whether you can net it off, right? Should not be netted off. Yes. Debit balance in creditors ledger. Yes, you have to show it. Got your point. That means you have paid more. Which has happened because of the return. Yes, you have paid more, but after that the material you have returned to the creditors and naturally you have deducted it. So a debit balance is lying. It has to be shown separately. Debit balance in the creditors account. Yes. Otherwise, the disclosure is, problematic. You're netting it off against the other creditors. Good point. Okay. So, we move to the profit and loss account. So, similarly, we have a format in Schedule 3, how the income and expenses will be, income and expenditure will be disclosed. So, keep in mind, revenue will be sale of products, sale of services, other operating revenues and things like that. And it should be reduced by, earlier it used to be reduced by the operating expenses used to be reduced by the excise duty. Why? Why it has to be reduced by the excise duty? Because you are holding it on behalf of somebody, right? You are holding it on behalf of somebody. You are not going to, you have just taken it to give it to the authority. It is not your income. You are just holding on behalf of a authority and you are going to pay it to the authority. So it is always used to be shown minus that. All right. So those kind of things are generally collected. So any indirect taxes which used to be there, and the GST from the customer on behalf of the government, in majority of the cases, they should be reduced from the, they are not an income. Okay. And the other way around also. And it is not, so only what we show as payable, only the net. Now today what we show as a payable is the net payable after taking into consideration the ITC. So it has a broad scheme of accounting entries given by the GST. What should be the broad scheme of accounting entries and one has to follow that. Okay, so the fundamental is that it should not take into consideration as income which some money which has been received on behalf of third parties like payment of taxes. Okay. Net of GST collected. So now that we are into the GST regime, so revenue should be presented net of the GST. So other income, what would be the other income? I mean, it's not defined, but anything which is not specifically related to the services or the, product of the company. Okay. Those kind of things one has to remember. Okay. So there is again, one has to be a little careful about other operating revenue and other income. So keep that in mind. Like, if any property, plants and equipment is sold, because it's not an operating activity. Take an example. Let's take the example, the sale of property, property, plant and equipment. Sale is not the operating activity of a company, right? So if any sale happens, it will come as another income, right? But it will not come as the other operating revenue. But if you are, like, say, if you are, there is a floor which is which the company owns, but it is given on rent because they are not using, that can be considered as the other operating revenue. Just some example, okay? But the manufacturing scrap, when the manufacturing scrap is sold, that should be the other operating revenue, because these are the byproducts or the scrap. They are by scrap which actually came out from the operation of the company. So sale of the scrap will be other operating income, revenue or income, okay, and not other income. So that's a subtle difference. Okay. And and of course we have interest and other financial services. Those are coming part of the revenue other than the normal operating revenue. Okay. So I think expenses, normal expenses that you get to see, cost of the material consumed, etc., and other expenses like purchase of stock in trade, change in the inventory. I'm sure you understand the very difference of, purchase of stock, consumption, and changes in inventory of finished goods. If you have any doubt, maybe the next week, the next class, I'll clarify. The last class of the company audit, I'll clarify. But for the time being, I assume that you understand these expense heads. So I'm not going into the detail of it. Employee benefits, the finance cost, depreciation and other expenses, they are part of the income. Part of the expenditure. So they are part of the expenditure. And depreciation, so little bit about the, so let's go into the little bit about the depreciation and dividend part of it, which could be, important for your exam purpose this time. For the final exam. It is dividend to be given out of the profit. All right, dividend to be declared out of the profit, and out of the profit provided, or out of the profit provided by the central government, state government, or for payment of dividend. All right, and so section deals with where it is to be, how it should be declared and how to be paid. Deposits of amount of dividend, it should be kept in the separate bank account. If it is decided that this much has been, to be paid, it should be immediately kept in a separate bank account. And if it is not distributed within a given period of time, it is an offense on part of the company. And if it remains unpaid for some reason, because it could not be reached to the holder, to the shareholder, it should remain in the unpaid dividend account, and after some time it should be sent to the central government. They cannot hold it in their account forever with them, for the ever with the company. All right. So we still have some time. Let's go through that in more. The dividend part of it. So it should be declared out of the current profit. It can be also declared out of the, past profit. That because of inadequacy or absence of profit in the current year, it can be declared out of the past profit. Fulfillment, subject to the fulfillment of certain conditions, is just like that. It cannot be. All right, you have to accept permissions and things like that, and it has to be declared it has to be paid out from the free reserves, not from any other reserve. Okay, so by the company from its free reserves only. And dividend, for all practical purpose, it includes the interim dividend also. Okay, it includes the interim dividend also. And payment of dividend, it has to be paid within 30 days. I told you before also, dividend once declared become the liability of the company and must be paid within 30 days from the date of declaration. Any failure to do so will actually is penalized. The company will be penalized for that. Associated with the, company means who are associated with the company for such failure, it will be penalized. And it must be made to the registered shareholder. So the register has to be closed. So there are certain, norms for closing the members register. And only after it closing, whoever are the members as on the closing, they are entitled to such dividend. Okay, say they are entitled to such dividend. And it can be capitalized also if profits or reserves can be capitalized for the purpose of fully bonus shares. It can be paid as bonus shares. So you don't pay out the dividend, but it is capitalized by issuing bonus shares. Right? Many times combination happens, and many times what happens that you get a bonus share. That instead the profit is very good, and whatever the reason, not only profit is good, but company declares bonus shares. So here what is happening, the profit is getting basically capitalized. Okay. So deposit of amount of the dividend in a separate bank account has to be kept, and within 5 days from the declaration of the declaration of such dividend. And so if it is not paid, director of the company who are in default knowingly will be punishable and liable to pay interest, at 18% per annum. So these kind of things should be kept in mind. And it can so happen there could be some cases of dispute. So they can be kept in, they may not be paid. Okay. So it will not be considered, no offense will be considered on part of the company if there is a dispute. Okay, if there is a dispute or for some legal reason it cannot be paid, those kind of things can be taken into consideration. Okay. Unpaid dividend account. Unpaid dividend account under section 124, it talks about unpaid dividend account. So it has to be, which remains unpaid and unclaimed within 30 days from the date of declaration of such dividend, shall be transferred to the company to a special account, special account called unpaid dividend account, opened in any scheduled bank. So any scheduled bank it can open and it will remain there. The dividend has to be paid in, cash, or in cash means not, in online mode, or through checks, or as I said, through bonus shares. Okay. And such transfer shall be made within 7 days from the expiry of the 30 days. In case of an unpaid, yeah. Okay. So students, it's past 10 and I think I need to wind up now. And so we'll continue day after tomorrow with the rest of the, these dividend, depreciation. And one of you said about the cost audit, probably yes. And CARO. We will be talking about the CARO in detail, the contents and the requirements of CARO in detail. So till such time, have a good day and please post your queries in case you have some in the course of today's class. Thank you very much. Have a good day. Thank you.